Hello everyone. The title of this video is not meant to be sensationalized, but I want to explain exactly what it means. The government is not literally coming to your house to take your retirement savings away. However, it has created a complex set of rules surrounding your 401k and IRA accounts that, if you don't fully understand them, could cause 25% to nearly 50% of your withdrawal to disappear into taxes and penalties instead of ending up in your bank account. And in 2026, several of these rules change in ways that are surprising many Americans who never saw them coming. Today, I'll explain exactly where people lose money, how much they can lose, and most importantly, what steps you can take to safeguard the retirement savings you've spent decades building. Before we begin, make sure you subscribe to the Frank American and turn on notifications. The retirement account regulations we're discussing today change frequently, and most financial institutions only explain the details deep inside lengthy fine print. Subscribe now, and let's get started. Let's begin with one of the costliest mistakes people make with retirement accounts. Ironically, it often happens to people who spend decades doing everything correctly and then overlook one important rule near retirement. When you contribute money to a traditional 401k or a traditional IRA, you receive a tax benefit immediately. You don't pay income taxes on those contributions at the time you make them, but that tax bill doesn't vanish forever. It is simply postponed until later. Eventually, the IRS requires you to begin withdrawing that money and paying the taxes that have been deferred over the years. This requirement is known as a required minimum distribution, or RMD. Here's how it works. In 2026, if you were born between 1951 and 1959, your RMD age is 73. That means during the year you turn 73, you are required to begin taking yearly withdrawals from your traditional IRA and 401k accounts. If you were born in 1960 or later, your RMD age is 75. The amount you are required to withdraw each year is determined using IRS life expectancy tables and a balance inside your account. It is not a fixed percentage and will change every year as both your age and account balance change. So, what happens if you fail to take your RMD? The IRS imposes an excise tax penalty equal to 25% of the amount you should have withdrawn, but didn't. For example, if you were required to withdraw $20,000 and missed it entirely, you could owe a $5,000 penalty, and that's before accounting for the regular income taxes you'll still owe once you eventually withdraw the money. The good news is that if you discover the mistake and fix it within 2 years, the penalty may be reduced to 10%. Still, the smartest strategy is simply to know when your RMDs begin and establish an automatic process ahead of time. Companies like Fidelity, Vanguard, and many major brokerage firms can calculate and automatically distribute your RMDs if you request that service. Now, let's discuss a hidden trap that many retirees unknowingly fall into. When you become eligible for RMDs, you have two choices. You can either take your first RMD during the calendar year you reach your required age, or you can delay it until April 1st of the following year. At first glance, delaying sounds attractive because it gives you additional time. But here's what many people don't realize. If you postpone your first RMD until April 1st, you are still required to take your second RMD before December 31st of that same year. In other words, you could end up taking 2 full RMDs within a single calendar year. That means 2 large taxable withdrawals hitting your income in the same 12-month period. This can push you into a higher tax bracket, increase the amount of your Social Security benefits that become taxable, and in certain situations, trigger Medicare IRA surcharges, which we'll discuss shortly. For many retirees, taking the first RMD during the year becomes due instead of delaying it until April is often the simpler and less expensive option. The second major change for 2026 involves catch-up contributions for higher income workers. This change surprised many people because it was buried inside the Secure 2.0 Act that passed back in 2022, but only officially took effect this year. Catch-up contributions are additional amounts that workers age 50 and older are allowed to contribute above the normal annual 401k limit. In 2026, the standard 401k contribution limit is $24,500. Workers who are 50 or older may contribute an additional $8,000, allowing them to contribute a total of $32,500. But here is the new rule. If your earnings from your employer exceeded $145,000 during 2025, all of your catch-up contributions in 2026 must be directed into a Roth 401k instead of a traditional pre-tax account. You can no longer place those extra contributions into a pre-tax account. What does this mean in practical terms? It means that if you're a higher income worker making catch-up contributions, you'll now pay income taxes on those contributions during the current year, instead of delaying those taxes until retirement. As a result, your take-home pay may decrease, and your current tax bill may increase. Some people consider this a disadvantage, while others see it as a valuable opportunity because Roth funds grow tax-free, and qualified withdrawals are never taxed again. The important thing is to understand this change before it affects your paycheck unexpectedly. There's also a special catch-up provision available for a very specific age group, people between 60 and 63 years old. For these individuals, the catch-up contribution amount is even larger. Instead of an $8,000 catch-up allowance, they can contribute an extra $11,250. When combined with a standard annual contribution limit, someone between ages 60 and 63 can contribute as much as $35,750 to a 401k in 2026. This creates a powerful opportunity to accelerate retirement savings during a relatively short window of time. If you're currently between 60 and 63 years old, this may be one of the strongest retirement savings opportunities available to you. Once you turn 64, the contribution limit returns to the standard catch-up amount. Now, let's talk about what I call the double impact, because this affects retirees taking RMDs, people selling property, and anyone who experiences a major income event during retirement. Most Americans don't realize it's happening until they notice a larger Medicare deduction being taken from their Social Security payment a year or two later. Medicare Part B premiums are not the same for everyone. If your income exceeds $106,000 as an individual filer or $212,000 as a married couple filing jointly, Medicare begins charging additional fees known as IRA surcharges on top of the standard monthly premium of $222.90. These extra charges can range from an additional $69.90 all the way up to $443.30 per person every month. Here's what creates this double impact. Medicare doesn't use your current income to determine your premiums. Instead, it looks at your tax return from 2 years earlier. So if you take a large RMD during 2026, that raises your taxable income for 2026, and that higher income could increase your Medicare premiums in 2028. In other words, anytime you take a large withdrawal from a retirement account, whether it's an RMD, a Roth conversion, or even a voluntary distribution, you need to think not only about today's taxes, but also about the effects 2 years into the future. For example, a $50,000 RMD might seem manageable when you're only looking at your current tax bill, but that same withdrawal could eventually add thousands of dollars in Medicare expenses 2 years later. People who understand this plan their withdrawals carefully. They spread distributions over multiple years, manage their income to avoid crossing IRA thresholds, and use strategies such as qualified charitable distributions to lower their taxable RMD amounts. A qualified charitable distribution, or QCD, is one of the most overlooked tax-saving tools available to retirees. If you're age 70 and a half or older and have a traditional IRA, you can transfer up to $108,000 directly from your IRA to an eligible charity. That transfer counts toward your RMD, and most importantly, it is completely excluded from your taxable income. You never pay income tax on those funds. In 2026, the annual QCD limit is $108,000 per person. For a married couple where both spouses have IRAs, that means up to $216,000 can potentially be distributed directly to qualified charities while simultaneously satisfying both spouses' RMD obligations. If you regularly donate to your church, university, hospital, or another qualified nonprofit organization, this strategy allows your charitable giving to work alongside your retirement plan instead of increasing your tax burden. Now, let's discuss inherited IRAs, because this is one area that catches many families off guard and often results in some of the biggest tax surprises. If you inherit a traditional IRA from someone other than your spouse after December 31st, 2019, you're generally subject to what's known as the 10-year rule. This means the entire account must be emptied within 10 years after the original owner's death. You have flexibility regarding how you withdraw the money during those 10 years. You could take a little each year, wait until the final year, or create your own schedule. However, by December 31st of the 10th year, the account balance must be zero. Every dollar you withdraw is treated as taxable income during the year you receive it. The problem is that many people inherit an IRA and then ignore it for several years. Later, around year 8 or 9, they suddenly realize they have a short amount of time left to withdraw a large remaining balance. If the account has continued growing and the beneficiary is now earning a high salary during peak career years, the tax consequences can be severe. For example, an inherited IRA worth $300,000 that must be withdrawn over 2 years could easily push someone into the 32% or even 37% federal tax bracket during those years. A more tax-efficient approach is often to spread distributions throughout the entire 10-year period, withdrawing roughly 10% annually so that the additional income remains more manageable each year. If you currently have a sizable IRA and are thinking about eventually leaving it to your children or other beneficiaries, these inherited IRA rules deserve serious attention. It's a good idea to discuss them with a qualified tax professional. There are strategies available, including Roth conversions during your lifetime, naming certain trusts as beneficiaries under appropriate circumstances, and charitable remainder trusts that may substantially reduce the tax burden your heirs will eventually face. So let's summarize the entire picture. Missing an RMD can cost you a penalty equal to 25% of the amount you failed to withdraw, although that may be reduced to 10% if the mistake is corrected within 2 years. The 2 RMD trap occurs when you delay your first distribution until April 1st, which often creates unnecessary tax complications and should generally be avoided. Beginning in 2026, anyone earning more than $145,000 must place catch-up contributions into Roth accounts instead of traditional pre-tax accounts. So prepare now for the after-tax impact. The special age 60 to 63 super catch-up opportunity allows contributions of up to $35,750, but that window is temporary and won't be available forever. Large retirement account withdrawals can trigger Medicare IRA surcharges 2 years later, so always plan with that delayed effect in mind. Qualified charitable distributions allow eligible individuals aged 70 and a half and older to satisfy RMD requirements while paying no income tax on the donated amount. And inherited IRAs generally must be emptied within 10 years, making it important to spread distributions out instead of creating a huge tax burden at the end. These rules weren't created overnight. The government has built and expanded them over decades, and they're not disappearing anytime soon. But understanding them ahead of time can make a tremendous difference because it allows you to keep more of the money you've worked your entire life to save. That's ultimately what this is all about. If you found this information helpful, subscribe to The Frank American. Share this video with someone you know who has a 401k or an IRA, and I'll see you in the next video.